In today's video, I'm going to answer the question, can you retire on life insurance alone? Hey folks, I'm best-selling author David McKnight. In today's video, we're going to be discussing whether or not you can fund your entire retirement plan with permanent life insurance alone. There's a certain segment of the financial services industry that specializes in permanent life insurance, or what I refer to as the Life Insurance Retirement Plan, or LIRP. Invariably, some of these advisors end up promoting life insurance as the only viable source of tax-free income in retirement. In other words, if you need to save money for retirement, you should only be doing so inside the Life Insurance Retirement Plan. If the LIRP has good and admirable qualities, then it should become the main cog in your retirement plan, or so the thinking goes. And in the process of glorifying the LIRP, these advisors denigrate every other legitimate tax-free alternative available to the consumer within the IRS tax code. In short, they promote the LIRP to the exclusion of every other viable tax-free bucket of money. Well, this type of strategy is wrong and misguided on a number of fronts. As I've stated in previous videos, every stream of tax-free income has unique attributes that sets it apart from all other streams of tax-free income. For example, the Roth conversion has no limits. If you had $1 billion in your IRA, you could shift every last dime of it to your Roth IRA. Not so with the traditional Roth IRA, which has a contribution limit of $7,000 per year. The Roth 401k gives you a company match. The LIRP does not. The LIRP gives you a death benefit that doubles as long-term care, whereas the Roth IRA does not. The Roth IRA has instant liquidity, whereas the LIRP does not. It just makes sense to have multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket in retirement. You have to take advantage of every nook and cranny available to you in the IRS tax code. But beyond the wisdom of not putting all your eggs in one basket, there are two major reasons why you shouldn't adopt a single monolithic LIRP-only strategy for retirement. The first reason is sequence of return risk. Sequence of return risk is the risk you face when you're forced to take money out of your retirement plan in a down market. Doing so could send your portfolio into a death spiral from which it never recovers. And yes, your LIRP can be exposed to sequence of return risk. I know what you're thinking. Dave, you told me that the LIRP was safe and productive. You told me that I could never lose money in my LIRP. That's true. I have told you that repeatedly over the years. Here's the issue. While the LIRP is guaranteed against any stock market loss, your policy could potentially lose money if the indexes to which the LIRP is tied have a flat or down year. Let me explain. In the LIRP, known as Indexed Universal Life, the growth of your cash value is linked to the upward movement of a stock market index, typically the S&P 500. Whatever that stock market index does over the course of the year, you get to keep up to a cap. Let's call that cap 11%. And if that stock market index ever goes down, then they simply credit you a 0. So your returns will always be between 0 and 11, or whatever that cap happens to be. Here's the rub. Even though you didn't lose money in that stock market index, the life insurance company continues to take money out to pay for administrative fees and the cost of insurance. So in theory, during those years where you neither gained nor lost, you still technically lost. Now, let's assume that your LIRP is your only source of retirement income. In that scenario, you'd be forced to take money out of your LIRP to pay for lifestyle expenses, even during the down years. So you have money coming out in the form of a withdrawal to basis or a loan, but you also have those expenses coming out, and you had no growth on the policy that year. If this were to happen a couple years in a row, your policy could go into a death spiral from which it never recovers. And that's precisely why your LIRP should not be your only source of income in retirement. Now, there are strategies where you do pay for your lifestyle expenses out of your LIRP when your stock market portfolio is down, and that gives your retirement accounts a chance to recover, and that spares you from sequence of return risk on your stock market portfolio. That's precisely the strategy I outlined in my book, The Volatility Shield. But that's not what I'm describing here. What I am describing is a scenario where your LIRP is your sole source of income in retirement. By repeatedly taking money out of your policy while your account is down, then your policy could go bankrupt years in advance of when you ever thought possible. And that could saddle you with a massive tax bill from the IRS. Remember, if you don't have at least $1 of cash value in your policy at death, then the IRS makes you pay all the taxes that you'd gotten out of paying up to that point in your policy, all in 1 year. Not a happy day when that letter arrives in the mail from the IRS. If you have a Roth IRA or Roth 401k, you won't be forced to rely on the LIRP in up years and down. You can withdraw money from all of your tax-free accounts in strategic ways so that you shield yourself from sequence of return risk and your retirement savings last much, much longer. Okay, folks, it's time for the Power of Zero question of the day. What are your top 3 favorite streams of tax-free income? Go ahead and put your answers in the comment section below. The second issue associated with making the LIRP your sole source of retirement income is that the LIRP is not a substitute for the stock market portion of your portfolio. Its growth is not sufficiently robust to stretch your retirement dollars throughout the life of your retirement, throughout life expectancy. Remember, if you retire at 65, you need your money to last 30 years or longer. The stock market is the best candidate to deliver this type of growth. If structured properly, your LIRP will deliver between 4 and 6% net of fees over time. And while that could function as a marvelous bond substitute, it cannot take the place of the stock market portion of your portfolio. In short, don't adopt a strategy in which you put all your eggs into the LIRP basket. Doing so could cause you to run out of money a lot sooner than you ever thought possible and saddle you with a massive tax bill along the way. The best retirement strategy calls for multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. And why do I love the 0% tax bracket? Because if tax rates double, 2 times 0 is still 0. If you want to learn how to adopt a comprehensive, balanced approach to tax-free retirement, head on over to davidmcknight.com. We're happy to lend a hand. Don't forget to click like, subscribe, and the bell so you never miss a video. And feel free to make comments or ask questions in the comment section below. This is David McKnight. I look forward to seeing you on the next video.